Welcome and thank you for joining us today, either live or watching the recorded webinar. My name is Siboniso Nxumalo and I'll be your host for this webinar. I am joined by Siboniso Nxumalo, Head of Old Mutual Equities at Old Mutual Investment Group. Before I hand over to Siboniso, just some notes about today's webinar. We will follow a 30-minute format for this presentation, and the remainder of the webinar will take the form of a Q&A session. You can ask questions at any stage by entering them into the functionality below the slides on your screen. Please note that this webinar does not carry CPD points. Enough from me, and over to you, Siboniso.
Good morning, everybody, and welcome to our webinar the impact and opportunities of the recent market volatility. And I think given what has happened in the past month, I thought that it would be quite useful to reflect on history. And the first slide is basically I say COVID-19 will pass. And I mean, this is a picture from the press from back in the days when the Spanish flu was being feared. And you can see that generally, there's a peak in terms of the people that actually in mortality, and actually then it drops off. And so this is what we feared, because the Spanish flu infected 50 million people, and that's a massive number. It's unlikely we're going to get there, but a year from now, 2 years from now, this too will pass, and this will just be a story. So how we hold our heads as investment managers and how you hold your heads as clients in this period in time actually is going to be determined by how we act today. And so, but we must always keep in mind that in markets crashing and the panic that is going on, that actually at some point this will pass and this will just be a story. But it will be a story that has provided opportunities, and we are going to get into that. I think before we start, we're going to frame the stage in the way that we've framed it even before the virus. We think that the stage is set for a low-growth world, and we start at the top. We think the world has got demographic challenges. The aging population, especially in Europe, in the developed world, which is in Europe and Japan, and somewhat in America, actually that's going to play a role in how society shapes up. I think in terms of consumption, older people consume very differently from younger people, but the demographics are looking unfavorable. Now, we think we've reached peak globalization. What do we mean with that? I think trade wars are an illustration of that. Peak globalization means that practically what we're looking at is that the world, in terms of globalization and the advancement of trade, that seems to be starting to reverse. Now, this was before the virus. Now, if you look at the impact of the virus, that China as the world's factory has basically shut down for a little while, that every company in the world is now looking at their portfolio and their supply chain and saying, hey, wait a minute, should we have our supply chain in China? Can we not produce it more locally? Even some of the companies in South Africa that we've spoken to are asking the same question, which tells us that we might be entering a phase of deglobalization. That's going to have an impact on profits and actually probably going to lead them lower. Populism has grown, and populism leads to more taxes. If you listen to the American political debate, it's died down a little bit now because of the coronavirus, but there's quite a lot there about taxing the tech companies and all of these things. Populism and redistributing wealth globally is a big thing. And again, that's going to have an impact on global profits. Regulation, there's a lot more regulation going on globally, and this is a global phenomenon. Even in South Africa, if you look at the last week, MTN announced the deal that they had reached with the government in terms of lowering data costs. Now again, that's regulation. What does that do to profits? It lowers profits quite a bit. And so again, sustainability. So if we look at the world, we're talking about ESG, we're talking about sustainability, and being environmental actually is going to cost companies. It's going to cost car companies from actually, they've got to emit cleaner fuels. But again, that's going to have an impact on profits because you can't just price that. And finally, one of the biggest impacts on profits and a key theme that has been going on through the world is disruption. So think technology, the world of Amazon and Facebook and all of these companies that are simplifying how things are. COVID is actually just speeding this up because the movement from offline to online is now speeding up. And so when we aggregate all of these, we sit there and we say, you know what, going forward, even before COVID, we saw a world of peak profits where we have to think really smartly about the companies we're investing in, the environment we're investing in, and then how that actually grows. And so that's what we are going to deal with. But if we go forward, I think, how am I going to frame this discussion? We call it investing in a time of unknowns. I think this Donald Rumsfeld, when he was trying to justify the U.S. invasion of Iraq, he made this quote, which I think I'm going to make the bedrock of this presentation. He said, there are known knowns, there are things that we know that we know. There are known unknowns, that is to say, there are things that we know we don't know. And then there are unknown unknowns, there are things that we don't know that we don't know. And the management of that, in terms of investing in times like that, is going to frame the results that we ultimately get on behalf of clients. And I think the known knowns, let's start with the things that we know that we know. And I think we've had the fastest correction ever. I'm going to talk about that. Largest and fastest global stimulus package ever. Again, we're going to delve into that. But also, what's unique is that this particular crisis, the coronavirus, has an end point. So it ends at some point, and actually, so it's an event-driven crisis rather than a financial-driven crisis. And so again, we need to delve into that and what the consequences of that are. But we're seeing investment opportunities in South Africa because we're saying South African share prices are pricing in the worst downturn in history. And so, but is that true? Or does that present opportunity? That's what we're going to delve into. Let's start with the first one. What we know for sure. If we look at this chart, this is for the S&P 500 in America, and actually generally global markets correlated to this anyway. Between February and March, the sell-off of 30% was the fastest 30% drawdown in recorded history. And you can see it's even faster than it was back in the 1930s, the years of the Great Depression. And so in recorded history, we've had the fastest collapse of share prices globally, and clearly this has got consequences and has actually caused a lot of panic and a lot of anxiety in investors' minds. But also, what we know for sure is that the purple bars here show the 2020 stimulus, which has happened in the last, remember 2020 is only 3 months in. I know it feels like we've lived a whole year in 1 month, but if you look at between 2008 and 2010, the green bars, generally in this picture, the purple bars exceed the green bars, which means more stimulus as a percentage of GDP has been thrown in the last month than was thrown in the 2008 crisis. And so, yes, we've had the fastest market correction, but on the other side, we've had a lot of stimulus in the system, which hasn't quite really taken off yet. But even with that, there's a promise for more to come. So the Fed in America is talking about, we will do whatever it takes. Even South Africa today announced some bond buying to make sure that there's liquidity in the system. So there is a coordinated effort globally to try and pull the world and the global markets and the global economies out of this. But actually, what else do we know for sure? That this is a Time magazine article that says actually at the first coronavirus vaccine, human trials are beginning. So the manufacturer is already preparing to scale production. Now, if you listen to that, if you read the rest of that article, actually it talks about the pharmaceutical company Moderna Therapeutics that is actually clinical trialing human beings. So there's a very high probability that over the next 12 to 18 months, there will be a vaccine. So this is a really kind of different crisis because it has an end point. Because the day will come when there's a vaccine. So if we look at history, if we look at the H1N1 virus, which is also a coronavirus, that had a vaccine. We look at the SARS virus, we look at the MERS virus. There's a precedent here that actually it's either the virus burns itself out or there's a vaccine. So here, there are human clinical trials already. But the second one, this is actually very interesting and gives us hope. What do we know for sure? So this is the fastest coronavirus vaccine to clinical trials in humans. Because if you look at the other one, the SARS in 2003, the influenza in Indonesia in 2006, influenza in California, they're all getting faster and faster. And so therefore, there is room here for a positive outcome. Yes, we are all under lockdown and we are worried and we are scared and we've got to be careful in social distancing, but actually there's room here for a positive outcome, which when we think that the market is not pricing in or thinking about. And I suppose also, what do we know for sure? This is a chart from Goldman Sachs, and it talks about U.S. bear market and recovery since the 1800s. And if you look at this chart, the black bars are the average in terms of the decline. So this is from peak to trough in markets. And then the middle set of charts is the average length of the bear market, and then the last side is the average time to recover. So what kind of a recovery? People want to know, what kind of a recovery are we going to have? Basically, this is an event-driven. What is the event? The event is the coronavirus, which has an endpoint, as I've illustrated earlier on. And if you look at this, the fourth bar, the bar on the most left in each of these, shows that, yes, it declines quite a bit. It's very similar to the others, but lower than average. But the length of the speed is faster. So an event-driven, like our particular one, actually, so what happened in the last month, actually is fairly common with other event-driven bear markets since the 1800s. But the one thing we aren't really focusing on as a market yet is the fact that the average time to recover, that this event-driven bear markets generally go from trough to recovery in 12 months. And so, therefore, they are shorter, and the recovery is also materially shorter because there is an event. And if you find, again, if you find the vaccine, it solves the entire thing, provided, obviously, that this hasn't spilled on into the real economy. But so therefore, if you look at history here tells us that this is likely, yes, it's been sharp and brutal on the down, but actually odds are it's also going to be sharp on the recovery. And that's what history suggests. And I suppose I ask myself a question, because in this time we get a lot of questions from clients, and rightly so. It's clients' money, and clients are going to look at this and say, wait, my money went down 30% wherever I was invested, whether it was in America, in Europe. Actually, what do we do here? So I ask myself, in the midst of this pessimism, panic, and fear, what do you think is going to happen to share prices when the global infection curve flattens? Because we saw that in China. When that curve flattened, the Chinese market recovered. And also, the second one then is when the vaccine is announced. And remember, this is an event-driven bear market rather than a structural bear market. 2008 was a structural bear market. It took a long time to correct. But actually, this one is different. And so the key from our side is we need to invest in companies that will not only survive, but actually come out stronger in a stronger competitive position after this. And we're going to delve into some of where we see those opportunities. So what do we know that we don't know, now that we've dealt with things we know? I love this quote from Teal Swan. It says, we do not fear the unknown, we fear what we think we know about the unknown. And that is what has been driving share prices recently. And I think in this chart, in all truth, we don't know, and nobody does, the exact economic consequences of COVID-19. We also don't know its impact on trade and GDP and on company earnings, because it really manifested itself in the end of January, February, and March. And so, therefore, companies are only going to report Q1 by the time we get into April, May. So we're going to start knowing what the numbers are. Governments, GDPs, quarterly GDPs are also going to start coming out then. So actually, there's a gap between an event, we know that it's going to be bad, and the actual numbers coming out. So we know that we don't know certain things. And I think what is key here, this is TomTom data, this chart. So the red bars are the historical average in terms of traffic on the road from Monday, from Monday to the next Monday, so 7 days. And where you see more red, then you see the brownish grayish. Basically, it is telling you that the brown is the current traffic, the last 7 days traffic, and then the red is the historical average. So therefore, the fact that we're seeing all this red in these different countries, Paris, Rome, London, New York, Wuhan, and in Beijing, it tells us that traffic volumes globally are actually materially low. So we've had a global world that's gone into sudden stop. We had China first go on lockdown. China is the largest exporter globally. And so therefore we had that stopping. So where are people going to source the goods, and how does that affect supply chains? The other side of it, China now looks like it's coming out of it, but then, America is on lockdown. South Africa is on lockdown. India announced lockdown. The UK is announced on lockdown. So who's going to buy these goods that China now can? So therefore we had an economic sudden stop. We know the data will be bad. That's what the markets are telling us. That's what the practical data we see in terms of road traffic and things like that. And so therefore, we know that it's going to be bad, but we don't know how bad it's going to be. And if we look at the next slide, actually, if we look at the Bloomberg headlines, so Mr. Bullard from the Fed talked about how the jobless rate in the U.S. could soar in the second quarter to 30%. Remember, the U.S. is at record levels, lows of unemployment of just over 3%. And actually, he's talking about this multiplying by 10 times in the second quarter because of this economic sudden stop. And again, if you look at other side, the news headline, Morgan Stanley sees the U.S. economy plunging by 30% in the second quarter. These are massive numbers. These numbers are not recession numbers. We're talking here about global depression numbers. And again, here, I'm comparing the Great Recession versus the Great Depression. Great Recession being 2008, which was absolutely devastating and very difficult. But if you compare the blue line relative to the gray line, in terms of non-farm job losses in America, you can see that a depression is materially worse than 2008. And that's what the market is worried about. And the data that the world is saying, well, in the second quarter, it looks like we are going to get quite a bad outcome in data. But is it really going to be a depression? Because what do we know that we don't know? Because when we look at this is electricity production and consumption, which obviously indicates how an economy. And you can see that China being the line that fell first, in the gray line, in terms of coal used in electricity production and consumption, China's been trying to get its factories back on stream. And you can see it bottomed out around Valentine's Day there, February the 13th or 14th, and from there on, actually the production and consumption of electricity has been increasing in China. But even if you look at the others, so it's France, the US, and Italy, actually all of those are starting to tick upwards too. And so again, that bends the mind. So as we say, this crisis is big, it is worrying, but definitely it looks like the trends are actually turning on the up. And we mustn't forget that. The unknown unknowns. Ultimately, there's one massive unknown. We do not know how bad this gets. I mean, we look at the US, and the US looks like it's acting slower than the other countries. But there are other countries that have done very well to flatten this curve. South Korea, the primary example, you can see it down there in the blue. In Japan, they have managed this exceptionally well. Europe, which has been Spain and France, have generally been terrible at managing this. And the US is, at this moment, an unknown quantity. And so from our perspective, we're saying, you know what, the ultimate risk here is that we don't know how bad this gets. But we can see that governments globally have progressively become more aggressive in how they deal with this and how they're handling this. The shutdowns are happening sooner. They're becoming a lot stricter. South Africa is deploying the army. We don't just deploy that army for everything. And so therefore, and yet we know that the clinical vaccines are also in track. And so that is something to consider. And so now when we get to investments, spoken about all of the things we know and the things we don't know, in the midst of chaos, there is also opportunity. And I think from an investment perspective, this has presented some amazing investment opportunities. There are companies that we were struggling to buy last year, over the last couple of years, that are suddenly selling at prices that are exceptionally attractive for us. And whenever we invest, the price you pay in an investment drives your ultimate returns. And I think the one point I want to make here, so if we look at an index from 1960, this is the JSE's Financial and Industrial Index. And so from 1960, you can see the earnings actually, have generally grown over time. Yes, between 2015 to 2018, the earnings have gone sideways. Yeah, we know the country's been struggling in terms of South Africa, and the earnings haven't gone anyway. So my point here, we've got to focus on long-term earnings. Long-term aggregate JSE earnings have been actually relatively stable and and they've been growing over the long term. Now, if you look at the next slide, if I add the actual price, this is now the market price, so forgetting the company's earnings, you can see the market price is actually very volatile. So that is what worries people. But you can see, even with history, that the market price sometimes overshoots, like it did in 1968, the earnings, and sometimes, like in 1977, every crisis, the market price undershoots the earnings. And so, therefore, what are we saying? We're saying focus on the long-term earnings. They matter substantially more than the market price, because what we are seeing now is, yes, odds are you are going to lose maybe 6 months of company earnings, depending on where the company is. But actually, next year and the following year, those earnings are still intact. And when we look at businesses, when we value businesses, we're valuing businesses on their long-term earnings power and saying, well, over a body of work, over the lifetime of this company, what earnings does it earn during the peaks and the troughs? because we will come out of this, and there will be companies out of this, and some of them actually will be stronger. And I think also one thing we sometimes miss in terms of looking at the JSE's earnings is that actually over time the JSE has become very diversified. Now, at this present moment, this isn't really helping because this is a global virus, and globally things are shut. And so in South Africa, we were worried quite a bit about what was going on in South Africa itself, and worried about the issues in South Africa. But actually, if you look at our JSE, the earnings that you are exposed to are globally, are increasingly getting globally diversified. But at this present moment, though, that is unlikely to really bail anybody out. In fact, some of the economic numbers that are going to come out of these other countries are worse than the ones that are in South Africa. And so, therefore, it's also important to remember that the earnings is not just about South Africa when you're looking at the JSE. And I suppose, where are we finding the opportunities? I mean, this is always controversial because investing, if you invest in what is popular, investing in what is popular is really profitable because investing is largely about the price you pay. So when we look at South African banks, so here I've got a chart which shows the aggregate of the big four banks in South Africa. Now, the big four banks in South Africa being Absa, Standard Bank, Nedbank, and First Rand Group, they are now relative to other emerging market banks. Now, emerging market banks are banks in China, in Russia, in India, etc. So I'm comparing to what is, I think, an acceptable peer group. South African banks, on a price-to-book basis, are now trading at 0.77 times relative EM peers. Now, that is fine because maybe there are risks. But if we look at the chart below, South African banks' return on assets, now in terms of this is the earnings power and the profitability of South African banks relative to the same emerging market banks, since 2008, bottoming up in 2008, South African banks have become substantially stronger in terms of how they generate returns than the same emerging market banks. So it's either the market is saying South African banks are going to perform substantially worse than other emerging market banks, that the coronavirus will be worse in South Africa. Now that's an interesting thought to explore because the coronavirus is also in Brazil, in Russia, in China, in India. And so therefore, why will South Africa uniquely just perform substantially worse? Because and all of those countries are also under lockdown. But also one thing it misses, which I don't have on this chart, is that South African banks are well capitalized and have got inadequate levels of liquidity. So whenever we see fear running into the market, we look at this and we say, hey, there's an opportunity here, because what people are expecting for the banks, yes, the earnings will be lower. We agree with that. But the market here is saying that actually we're going to have capital issues in South African banks, and we are not convinced that that is the truth. And I suppose if you go further, if you look at the whole South African companies, price to book value, so price to the assets, this is actually cheaper than it has been in this sort of 30-year history. And again, we look at that and I say, well, each time it traded at bottoms, and all of those bottoms coincided with global issues. And so we've got to realize that. So in you had Black Monday back in 1987, and you can see that that was a fantastic buying opportunity. You had the Asian crisis in 1998, 1997, when long-term capital management, the very large hedge fund with smart people crashed in then. And again, you had the Asian crisis. And again, South African banks and South African assets were discounted because they're emerging market assets. They go in line with them. And again, if you look at it relative to the 2001, 2002, the dot-com bubble, again, assets were very cheap. And then we've got 2008. And so today, you look at the last dot over there, we are cheaper than all of those outcomes. So the question is the coronavirus, which is an event-driven virus, is the impact on it economically in South Africa the worst outcome that we have ever had in terms of a global crisis? Because if you have bought South African shares back in all of those other global markets, you actually had earned amazing returns. And amazing returns are always generated in times of discomfort, but they're also always generated when you are buying, when generally the market is in panic. And so that's how you build long-term wealth. So we look at this and we say, this is actually an amazing buying opportunity. If we go forward, so if we look at price to cash flow, because maybe the assets are not worth as much, that is the argument, but the price to cash flow on the right-hand chart reflects the same thing. That relative to cash flow, South African companies are still actually on the bottom end relative to where they've been in history. And again, this doesn't quite make sense to us. So what have we been buying? Because as people are panicking, we are finding opportunities to buy great prices that we think are going to exist a year from now, 2 years from now, 10 years from now. We've been buying Shoprite. When Shoprite was above 200 Rand, we were not interested because actually we just couldn't quite find value in the share. But with Shoprite having had issues in Nigeria, in Angola, with Shoprite having had issues in South Africa with their own supply chain and putting in terms of modernizing their IT software, suddenly the market sold Shoprite off. But then the coronavirus actually has further exacerbated that. If we can buy a company like Shoprite at 100 Rand, we are substantially happy because we think that over the next 10 years, actually that's going to create substantial value for clients. It's the largest retailer in South Africa, it's the largest retailer in Africa. People are going to eat, whether there's a virus or not. And so therefore, this is an attractive asset for us to buy, and we can buy it now because of the virus at an attractive price. We're buying quite a bit of Foschini. Again, this is a company that changed its supply chain quite a while back, actually, from sourcing from China to moving into a fast fashion world, and Foschini is several brands. And yes, they're probably going to struggle over the next 3 months because they're not a food retailer, but actually what the market has done with the share price for us to say, well, actually, this company can survive this and come out of this. And so it is looking exceptionally attractive, especially because it is sourcing its goods and its fashion in South Africa. But also, if you look at the fashion retail landscape, there are guys that are going to fail. So we're asking questions about Edcon. Does Edcon survive this? Because is this the death knell? And so all these small players who are fiddling on the fringes, the strongest will survive, and we think Foschini is one of the strongest, and it's got a balance sheet that can manage and survive. Wilson Bailey is a construction company. Basically, construction companies in South Africa have all relatively gone bust. And so generally there are two of them that can build anything material, which is Wilson Bailey and Raubex, and we own both of those, and we've been buying those in large instances. Why would you buy a construction company? Well, actually, every bit of stimulus, governments are talking about fiscal stimulus. How do you create stimulus? And history tells us that stimulus is largely created through infrastructure. And even in South Africa, if you look at it, there are several massive tenders that are out there. So, like Cape Town, the runway, there's a 3 billion Rand tender for expanding the runway in Cape Town International so that the Emirates A380 and those large planes can land there. Again, roads in Johannesburg, there's quite significant tenders in that. Water, Transnet, all of these, if the government really wants to kick off the economy, and which is what China does and what America is talking about, how do you institute fiscal stimulus where you're actually putting money into the real economy where you're going to employ people? And we think that these companies are amazing. If you look at the cash balance in this Wilson Bailey company, it's an amazing balance sheet and can weather the storm because it has weathered tough times. And so therefore, if the government starts spending anything, which it has to do in infrastructure, this company is going to get involved. And actually, I think clients can make multiples of their money in this. Supergroup, a logistics company, again, sold off tremendously. But again, someone's going to need to move goods. This company is going to be around. When we started buying the company, it was probably trading at 3 times forward. And so that's an attractive price. We haven't seen prices like this in South African assets since 2001, 2002. This is attractive prices. Capitec Bank. I think times like crisis, you get people to panic. And actually, 2 weeks or whatever, not this current week, the previous week, we saw someone selling Capitex, which moved from about 1,200, 1,300 all the way to close to 600 Rand. We went in on those shares. Why? Because Capitex is a phenomenal business. Will they have bad debts? Yes, they will. But actually, Capitec is growing north of 20%, and it appeals to one of the lowest cost providers in banks. It's a fantastic business. A year from now, 2 years from now, 3 years from now, once we have forgotten about Corona, this will still be a strong business that is relevant in the market. Massmart. Massmart has been under immense pressure, and Massmart owns Game. Well, it closed, it's restructuring itself. It closed the DNY stores. But the big thing, it owns Macro. And if you look at the signs and the queues outside Macro, that tells you something. That business is relevant. And so therefore, how valuable is this business? And it also owns Builders Warehouse and those Builders shops. And so we think that these businesses and the work that Massmart has been doing in restructuring itself, and obviously it's owned by Walmart, so it's got a rich parent with a lot of capital to deploy. Hey, there's an opportunity here. We can buy these companies at single-digit multiples, and we can see how the earnings in these companies, when this virus passes, can actually just grow exponentially. And so that excites us. So we're seeing opportunities we haven't seen in a very, very long period of time. And then if we look at our Old Mutual Investors Fund, our top 10 shares, our biggest share is British American Tobacco, which has done obviously very well, because whatever happens, people are going to smoke. Probably in times of panic, you could argue they will smoke more. And so very stable, very defensive company. And then obviously we've got Prosus, which is owned by Naspers, which is driven by Tencent. And again, the whole gaming evolution, that if you lock the kids in China, then they're going to game more. And so that's it. But we've been buying FirstRand Bank. We're buying it at half the prices you could buy it last year. It's a fantastic business. We like FNB, we like RMB, we like what they've done with the business. And in terms of banks, in terms of emerging market banks, and actually global, this is one of the finest banks in terms of globally. And so this to us, to buy such a bank at such prices, excites us, and actually we think, wow, we buying it at half of what we bought it last year. So that actually excites us. I think we can create value. Old Mutual, our employer, and again, a solid business, largest distribution in South Africa. People are still going to save. People still need protection, risk, and savings. And mind you, in times like this, it shows you that there's a relevance for companies like Old Mutual. But Old Mutual is well capitalized. It's simplifying its business. It's taking out costs. We see a great opportunity at buying Old Mutual, again, at half the price that you could have bought it a year ago. And then we always had Anglo Gold. Gold, we think, is a wonderful hedge, especially as the Federal Reserve banks and all these are throwing tons of stimulus into the world and expanding their balance sheet. The Fed balance sheet is expanding at a rate faster than it did during the 2008 crisis, and so therefore there are questions there. So gold forms a nice hedge. Vodacom. This is a company actually that's probably going to benefit from this. So Vodacom, again, is a company we have owned for a while. But all of a sudden, you've got working from home, you've got communication. Remember, telcos were companies that were hated and loathed because they were structurally declining. But look at the number of phone calls you are making, how much data you are requiring. All of a sudden, this business that was being prized as a dying breed is now facilitating the economy of the future, which is now we're living in. Tile, again, a local tile producer. Yes, it's going to go through tough times, but it's got a brilliant balance sheet, a family-owned business, and really great business. Shoprite, again, I've spoken about Shoprite. Again, you see the cues. You see people, this is going to be a relevant business. Standard Bank, one of the largest banks in Africa by assets, and again, a very compelling business that if you look out 10 years from now, Standard Bank will probably still be the largest bank in Africa, and Africa will be growing because this will pass. And then the last one is Exxaro. Exxaro is the coal producer, and with a fantastic balance sheet and fantastic dividends. And of all the things that the government is going to cut, they're not going to cut coal to power stations because we need them. And so we found we could buy this company at attractive valuations. Yes, coal is dirty, but just like when regulations started coming in the US back in the late 90s on tobacco, it basically solidified an industry and made it substantially profitable. Coal is starting to take the same characteristics. Is that, yes, there's regulation, everybody hates coal, but actually we've built power stations that still need this stuff for the next 30, 40 years. China's got lots of those. So coal is relevant, especially if you can buy companies that supply coal with Eskom and etc. And so therefore that is going to be relevant for a long period of time. And so that is it from me. I'm going to now take your questions. But first, I'm going to fly through some of the disclaimers, which are small worded, and here we are. So let's have a conversation.
Thank you, Siboniso, for that insightful presentation. It is time for questions, and just from what has come in, an interesting question here. I understand you say this event is event-driven bear market and expect faster recovery, but how do you reignite global economies when many small businesses have shut down? Unemployment already in the US forecast at 20%. Surely this cannot be a fast recovery. All sectors of economies are going to be rebuilding. Your thoughts on that, Siboniso?
I think, again, if we reflect on history, history is a wonderful teacher, because I suppose in the data that I showed all event-driven bear markets since the 1800s. Now, when we are in the middle of an event, we always see the worst-case outcome. But the point here is true, that actually you've got companies that are going to fail. What's going to happen to restaurants? What's going to happen to the small SMEs? And this is a global question. I suppose our answer to it is that, yes, odds are it's going to take a little bit of a while for the economies to start going. We're seeing that in China. We're seeing the evidence of that. But also, I think we are overlooking the opportunities that naturally appear in markets like this. So if you go back and look at the US, look at how many companies which companies were started in the Great Recession, 2008, 2009. All these Ubers and Instagrams and all of these tech companies generally were started during that crisis. Why? Because as human beings, we assume that the models that got us to a place are the same ones that will take us forward. So in tough times like this, you've got people working in a new way. We've never worked in this working offline and working. This is going to create new opportunities that are unique. So yes, small businesses, some of them will fail, but actually, let's not overlook the fact that some of them will be invented and new ways of doing business. So I look at Amazon this morning. Amazon and Walmart in America are looking at this and saying, well, actually, we've got issues. We can't meet the desire for people for distribution. And so what is Amazon doing? They're hiring 100,000 retailers and people who will help them deliver their goods. Well, it's not going to be too long since the South African guys do the same. Because I went on ShopRite's 60/60 app the other day trying to buy some goods online. And they said, no, they're full. Okay, if you go and Pick and Pay, the lead times are long. If you go to Woolworths, the lead times are long. What does that tell you? That yes, somebody is going to suffer, but the world is changing, and there's an opportunity that there are people who are going to get employment in different areas. So to me, I acknowledge that, but we must also acknowledge that hard times always create new opportunities that are different, and economies have to just transition.
Thanks for that answer. I think time for a couple of more questions, not too many. The next question, Siboniso, is Sasol being in the top 10 of the Investors Fund, is it not a good time to also increase our exposure? And this also encompasses the question a little bit earlier. Please let us know your thoughts on Sasol.
Yes. Now, this is the controversial one. It's the big one, the company that has fallen 90%. I think it's actually useful to go back and talk through how did it end up here. So Sasol, which is a South African petroleum company, which wanted to diversify its revenue and then went to go and build a chemicals plant in Louisiana in America. Now, they spent $13 billion or so US dollars in building that. All was debt funded. And so anyway, we end up today with a company that previously had no debt but was very operationally geared to oil. All of a sudden it's got debt, so it's got financial leverage and operating leverage. And at the same time, you've got the coronavirus destroying demand, which means planes are not flying, we're not driving anymore. And so therefore, the demand for the commodity is low, which forces prices lower. And at the same time, Russia and Saudi Arabia enter into this price war, where they say, well, actually, the American shale producers have taken share from us. We are not willing to support the price by cutting our own supply, and so therefore we're going to pump a lot of supply and flood the market and lower the price. So that's what brought us here. These, besides the leverage part is a key issue to consider with Sasol. But the Saudi and Russia thing is the key part here. Because if the oil price was at $40, $50 per barrel at the same rand, Sasol would be fine and the share price would be in a very different place than it is now. And so, therefore, what do we do then? Then we look and we say, okay, fine. Is this oil price sustainable? Actually, and when we look at it, when we look at the cost of production for the Saudis and the cost of production for the Russians, but more importantly, the cost of production for the Americans in shale oil between $45 and $50 is what they need to be able to produce in America. And so therefore, they're feeling pain, which means their banks are feeling pain, which means something's going to give. The Russians also are feeling pain because they pay their social welfare and they run the economy based on oil that is higher than the current oil price. The Saudis are the same. They need a higher oil price. Even Nigeria plugs in close to $60 per barrel. And so therefore, yes, we held Sasol, but we're looking and we're saying, actually, wait, at this moment, I think time solves this problem. Now, do we add to the position? No. We're unlikely to add to the position. Why? Because actually there are two risks here that we can't manage. One is that there is operating leverage and financial leverage, is that the debt actually is rather high. They're going to come for a rights issue, but time is the friend of Sasol, because if Russia and Saudi sort out their issues and the oil price goes higher, then actually the share price will react. But there are risks to that, and it's not that simple. And so in a world where there's this much opportunity, where we can buy all these shares at such low multiples, us deploying more client capital into Sasol, at the moment we haven't found that to be the idea that we want to take, but we are happy to find other oil-impacted things like MTN there. That's worth a discussion. ShopRite, that operates in Nigeria and Angola, oil, there we're happy to have a discussion, because you've also got to consider the risk and the return.
One more question, because we've just got room for just one more. What is your upside to fair value in your funds, namely Investors Fund and Old Mutual Equity?
In terms of upside, so what we do, how do we get there? So to me, is every company that we look at, we value individually, and then that particular company, then we value then all the other companies in the market, and then we compare. And we say, well, if we invested in the Investors Fund, at this moment, you're probably looking at close to 30-40% upside relative to the market, which is looking at around 20 or so. So that's where we're looking at. But at this present moment, actually, we've also got to be honest and say, you know what, that's a very, very tough number to come down to, given the fact that we don't know where the earnings are. So that number is probably based on our long-term valuation assumptions and saying, actually, this is where the market is going to go. Can I also deal with this question about Time Bank?
Yes, very, very.
There's a question here about the rise of virtual banks, Time Bank, Bank Zero, and Discovery challenge the position of traditional banks. Yes, they will challenge some aspects, but you must remember that what has happened now, we've entered a crisis, and by virtue of a crisis, there are lots of experimental operations that will fail because funding suddenly dries up. And so, to me, I think these banks have a place in the sun, but a bank's true power is its ability to gather deposits, to let you trust it with your deposits and your wealth. It takes those deposits, which are generally cheap because you aren't really getting paid for them, and then it lends them on. Now, all these other banks, Time, Bank Zero, whatever, they've got to earn their place in the sun. Why has Capitec become the bank that it has? Because Capitec has, over time, convinced more and more people to trust it as a brand and actually and leave deposits and leave your salary in there. And so, therefore, yes, we think the virtual banks are a threat, especially on the payment side, but over the long term, generally, we think our banks are adapting enough and they're offering a compelling proposition, and it's going to be very difficult for anyone to dislodge, say, Capitec with their value proposition over the long term, because ultimately their clients also want a bank and a branch and want to go and talk to somebody. So not everybody wants to deal online, and so therefore you've got to have a blend, and I think the banks are adjusting, and at this price, they'll be okay.
Thank you, Siboniso. So I think that's where we'll leave it this morning. Thank you for that presentation and for the questions that have come in through from the audience. Unfortunately, that's all we have time for today. And we, from the team, we really appreciate your attention and thank you for listening. Goodbye.